Let's face it, the state of the American economy isn't the greatest right now. Inflation has been running rampant, which has caused interest rates to sharply rise in an attempt to cool inflated prices. So if you're in the market to borrow money for any large purchases, such as a new house or a car, you should expect to pay an arm and a leg in interest right now. Understandably, we're all at least a little on edge when it comes to our finances and the economic state of our country and the rest of the world. So when news broke last Friday that Silicon Valley Bank had suddenly collapsed after only 2 days of reporting their liquidity woes, it makes sense that those of us who have already been financially strapped recently would have some serious concerns about what this means for the near future. You're watching Wealthy Buddha, and today we're diving deep into the collapse of Silicon Valley Bank and what we as consumers can take away from this catastrophic development. Silicon Valley Bank was founded in 1983 in Santa Clara, California. Its clients included venture capital firms and startups, and it quickly became a prominent player in the tech sector. However, it remained largely unknown outside of tech circles until last week. Facing a sudden bank run and capital crisis, SVB collapsed Friday morning and was taken over by federal regulators. It was the largest U.S. bank failure since the downfall of Washington Mutual in 2008. So how exactly did this crisis come about? Surprisingly, SVB was never reckless with their money and had actually followed the mainstream rulebook when it came to managing their assets. In order to understand what happened, we first have to understand why Silicon Valley Bank was in a unique position in comparison to other, more diversified financial institutions. The success of SVB has been largely influenced by the success of the tech industry, seeing as the majority of their business was conducted in this space. For many years since the inception of SVB, this was a good thing for them. The tech industry was doing very well as a whole, and venture capitalists were giving a lot of money to startups and going through SVB to do so. Then 2020 happened. In an effort to protect the economy during the pandemic, the Federal Reserve lowered interest rates to an all-time low of 0.5%, triggering the tech boom of 2020 and 2021. SVB's deposits nearly doubled during this time, and as of December 2022, they had approximately $209 billion in total assets and about $175 billion in total deposits, according to their public accounts, making them the 16th largest bank in the United States. However, as we all know, the technology sector is currently no longer booming. As evidenced by the numerous layoffs we've seen in recent months by tech companies, the tech industry has been hit harder than others due to the Federal Reserve hiking interest rates in an effort to get inflation under control. This is because technology companies heavily rely on outside funding, venture capitalists that are willing to invest their money to finance riskier startups in the hopes that some of the companies they support will become successful, which was an integral part of Silicon Valley Bank's business. When interest rates rise, these venture capitalists are less willing to lend out their money to these companies because their risky investments become even riskier due to the higher cost of capital. This meant that many of the companies which were being financed through Silicon Valley Bank had to depend more and more on their cash reserves instead of outside investments. These companies had no choice but to continuously withdraw their money from their accounts at SVB, which was the first piece of the bank's trouble puzzle. In order to understand the second piece, we have to understand how banks typically make money. You may think that when you deposit money into your bank account, the money sits there safely until you're ready to withdraw and use it. But that isn't the case. In an effort to make money off of their deposits, all banks invest their customers' money elsewhere in outside assets. Before 2021, banks were required to keep 10% of their deposits as cash on hand as a security measure for an unexpected increase in withdrawals. However, that amount was decreased to a whopping 0% in 2021, which is just one example of the loosened monetary policies that have gotten us into this mess in the first place. Either way, Silicon Valley Bank was actually ultra-conservative in their investments. In 2020 and 2021, when SVB was receiving these large volumes of deposits and interest rates were extremely low, They decided to invest this money into long-term treasury bonds, which is typically a safe endeavor. A treasury bond is essentially a loan that one makes to the federal government, and in return, they receive a small amount of interest until its time of maturity, usually in 20 or 30 years. However, you don't have to hold the bond for the full term and can sell it at any time. The problem with SVB's investment in these bonds is that when interest rates began to rise, the price of the bonds they had invested in fell. This is because new bonds were being issued with higher interest rates, making them more attractive to new investors who could make more money off of the new rates. So the price of the older bonds had to fall as the only way they could compete with the newly issued bonds. This essentially created the perfect storm for Silicon Valley Bank. They had locked up their money in these long-term bonds at the same time that their customers were slowing their deposits and instead withdrawing large amounts of cash. They were quickly running out of money to give to their customers, and therefore were forced to sell their bond holdings at a steep loss of $1.8 billion. This was the beginning of the end for SVB. They had made this announcement on Wednesday, March 8th, and by Thursday the 9th, the share price of SVB Financial plummeted and was even dragging other bank shares down with it as investors began to fear a repeat of the 2007-2008 financial crisis. At the same time, since SVB's client base was so specialized, news spread incredibly fast throughout the tech startup world, and many of SVB's customers began pulling their money out of the bank at the same time. This was a textbook bank run, a recipe for disaster for any bank, but especially for a bank subjected to loosened monetary policies and untimely hiked interest rates such as SVB. By Friday the 10th, trading of SVB's stock was halted, and the bank was shut down and taken over by the FDIC. The government has since stepped in and promised that SVB's customers will have full access to their money, a move they were forced to make in order to maintain as much trust and confidence as possible after what happened. So what does this mean for the future of the economy? The Federal Reserve is currently stuck between a rock and a hard place. If they continue to raise interest rates, they may be helping to reduce the rate of inflation, but they're also taking the chance that more banks could follow suit and collapse, just as SVB and others have. The root of the problem is that our economy is propped up by the confidence of the American people in these banking institutions, and the confidence of the rest of the world in the value of American currency. As soon as these people smell trouble, more events such as the SVB collapse can occur, which can quickly spread into what is referred to as a contagion, leading to an economic recession or even a depression as it did in the fall of 1930. The steps that the U.S. government and the Federal Reserve have been taking this past week in order to mitigate the risk of future crises are necessary steps that need to be taken in order to avoid catastrophe. But will they be enough? Only time will tell. In the meantime, it's important that we keep a cautious eye out and stay up to date on how these events are unfolding. Remember, we are truly all in this together. Don't forget to like and subscribe, and from all of us here at Wealthy Buddha, thanks for watching.